Hey, welcome back to The Dive. Today on the show, we have the founder of TF Metals Report, Craig Hemke. He's back on to share his thoughts on the Fed's next move, his view on the recession debate. He will also touch on the massive layoffs this year, FTX, iron ore, silver, and gold. Hey, Craig, welcome back to The Dive.
Hey, Merry Christmas, Happy Holidays, all that jazz, Cassandra. Nice to see you.
Merry Christmas to you too, Craig. Okay, now let's start off with the Fed. Inflation came down to 7.1% in November. The bond market seems to think that the Fed's rate hike cycle will be short-lived. Where do you see the Fed going from here?
Yeah, the bond market is the one that's sniffing them out. You could say gold and silver are as well. If you were to encapsulate it, the Fed played games for too long in 2021 with all that transitory stuff, and they continued QE and they continued to hold rates at zero way longer than they should have. And thus inflation got way higher than it should have, when it peaked out at whatever 9% annualized. And part of that was due to the Ukraine war starting. I think that kind of delayed their schedule by about 90 days as well. Now they're overshooting in the other direction. They think inflation is staying high and persistent, but already they've raised rates so high that inflation is coming back down. And now they're going to overshoot on the other side. They're going to keep rates up too long. And the U.S. economy is crashing. You can see that in almost any economic data point that you pick, whether it's the employment report, which is coming down and vastly overstated as we're finding out, or whether it's the purchasing manager indices, what are called the PMIs. When those are under 50, that's considered recessionary. In fact, the manufacturing PMIs from different branches of the Fed are well under 50. Those are predicting they've predicted 8 of the last 8 recessions when they get down this low. So the Fed is overshooting, keeping rates too high. The bond market is sniffing that out and rallying, and rates are coming down on the long end because the bond market knows that a recession is coming next year. That's eventually going to lead to rate cuts and more QE. And that may happen sooner than people expect in 2023.
Yeah, speaking of recession, we're subscribed to the TF Metals Report, and you mentioned in your most recent blog that the U.S. economy is grinding deeper into recession territory. Could you give us some more color on this?
Well, again, it depends on which indicator you want to look at. I mentioned those PMIs, the Chicago Fed, the Philly Fed, the New York Fed, all have those purchasing manager indices, PMIs. And for the manufacturing sector, all of them are in contraction territory. In fact, any reading under 50 is considered to be a contracting economy, and they're all below 40. Now, those PMIs, they've been put out for decades, and like I said, they have, anytime you get under 40, they predicted 8 of the last 8 recessions. A recession follows every single time, and it's been 100% accurate. Or you can look at the yield curve. A lot of times we look at the 2-year note versus the 10-year note, and if the 2-year note yields more than the 10, we say that's an inverted yield curve. Well, not only is the 2-year yielding more than the 10, but Fed funds, the 3-month T-bill, all the really short-end stuff, is yielding far more than the 10-year note or the 30-year long bond. That inverted yield curve, that almost bats 1,000 as well in terms of predicting recession. And so the data is all suggesting that if the U.S. isn't already in a recession, or been kind of scraping along the bottom of the ocean floor here in 2022, that it's going to be recognized as a recession in the first half of 2023. I have no doubt that that's coming.
There's news that Goldman Sachs Group will lay off up to 4,000 people. We've seen a lot of layoff news this year. How do you think about this as a general investor?
Yeah, that's where you kind of have to think for yourself. You can't just take the news as it's fed to you by CNBC or Bloomberg, or even your local newscast. The most recent jobs report that came out on the first Friday of December, they come out on the first Friday of every month, tried to tell you that the U.S. had added 260,000 jobs in November, and that was some sign of some robust economy. But if you dig deeper into it, the reason why they're able to post a net gain of jobs is because so many people are losing their full-time job, like what you mentioned at Goldman Sachs, or you just go down the list of companies that are laying off full-time employees. Those are good-paying salaried jobs. And then the people that get laid off, they're desperate to keep making ends meet and replace that income, so they'll go take 3 part-time jobs. You might lose your salary job paying you $4,000 a month, and then you take 3 part-time jobs paying $1,000 a month. Just try to keep everything afloat. Well, that's a terrible thing for the people that lose their jobs and are forced to do that. But for the Bureau of Labor Statistics, they count that as a net gain of 2 jobs, which that's what gets reported. And the Fed looks at that and says, oh, look how strong the economy is. It's not. And even those job numbers, as reported by the BLS, are going to start coming in sharply in the first quarter. I'm sure of that, too.
Now, shifting gears a little bit here, we saw you retweeting videos of Kevin O'Leary's FTX endorsement. Do you think that people who endorsed FTX should be facing serious consequences?
Oh, I don't know. How could they have known that it was a scam? Like O'Leary or Tom Brady or some of the, Matt Damon. I mean, O'Leary maybe is a different case because, he purports to be such as this brilliant guy that runs a hedge fund. So maybe you'd expect him to know better, to kick the tires, and have a better idea of what he's investing in. But this notion that somehow Tom Brady or Matt Damon or some of these other celebrity endorsers were somehow culpable in that, I think that's kind of a spacious argument. I mean, I don't think, again, your average meathead football player or actor is probably really knows the ins and outs of how a Ponzi scheme like that worked. They just probably got sold the idea by this, the salespeople like SBF, saw the check, and decided to play along. So I don't know about that, but this O'Leary guy, I just think he's pretty slimy. He goes about making it sound like he's the smartest guy in the world, and then his defense is, oh, but I didn't know. How would I know? And I'd still support him. Like, come on, man. It'd be interesting to get him, when they do these investigations, get him under oath and see what he has to say. Subpoena him in front of Congress and see what he has to say.
Okay, now let's talk about iron ore. As early as next year, a new Chinese state-owned agency will start consolidating purchases on behalf of approximately 20 of the largest Chinese steelmakers, or about $160 billion of iron ore trade. How big of an impact do you think that this will have on the iron ore market?
Well, usually when you can start to consolidate pricing power, that's usually detrimental to everybody else and causes higher prices, right? You get some kind of monopolistic control. Now, whether that'll ripple through all the way around the globe, we'll see. But I would take that story and put it as part of a more broad story of commodities in general. I had thought this year commodities would be impacted positively by China coming back online. You may recall, Cassandra, earlier this year talking about what we called the Chinese credit impulse and how that has always driven, when it's going up, higher commodity prices. And it's basically China accumulating commodities, whether it's iron ore or copper or, any other metals or grains or, anything else for that matter. But instead, China stayed locked down for most of this year, and that credit impulse never really kicked in. But now China is moving in that direction. And so you just wonder, in a world where commodity supplies are already pretty tight, and you feel like physical stockpiles are dwindling. And I've seen charts. It's not just the precious metals, but copper, lead, zinc, aluminum, all of those physical stockpiles around the globe are trending lower. What impact would China fully coming back online with demand have on those commodities? And I think we're going to get a chance to see that in 2023.
According to a COMEX report, the silver registered ratio reached 11.1% of total inventory last week, the lowest since January of 2000. Based on the recent data, what impact do you think that this will have on silver prices?
Well, that gets back to what we were just talking about, kind of a shortage of supply. I don't know. I follow all those COMEX numbers for over a decade. I wouldn't get too carried away about, the registered versus the eligible. Um, it's something to monitor. There's still maybe twice as much silver totally in the vaults as there was in 2016. So the amount that's marked registered, which means it's um, readily available to deliver, I mean, it's got a warrant attached, you can use it to deliver versus a contract. That number's back down close to where it was in 16, but the rest of the amount that's marked eligible, that's just metal being stored there, is about twice as what it was 5 or 6 years ago. Now, what's that metal there for? Is it part of the SLV? Is it JP Morgan's own silver that they've accumulated over the years? No one knows. I think it's part of a bigger picture, though. We've seen massive drawdowns of silver out of London. The London vaults are down to about maybe 800 or 900 million ounces, and the vast majority of that is alleged to be part of the SLV. And as I mentioned, it's not just silver, and it's not just New York and London. That metal appears to be short supply around the globe. And then you throw on top of that report out of the Silver Institute last month, which projected at least a 100 million ounce supply deficit next year, meaning demand is going to exceed the total available supply through mine supply and recycling by at least 100 million ounces. So that's going to further draw down the stockpiles. I think that more so than just that COMEX data point, I think in the grand scheme, the entire demand globally versus the entire supply globally is definitely having an impact and going to continue to have an impact.
Last question that we have for you here, Craig. What is your outlook on gold? Will 2023 be the year that gold shines?
Yeah, I'm very confident about where we head from here. I've been, as you guys, Cassandra, I write this article usually in the first week of every January where I call it my macro cast, where you kind of project the year ahead. And the last couple of years have been pretty good. This most recent year, 2022, didn't see the dollar rallying as far as it did. I thought the Fed would pivot by summer, and now here we are into December, and they're just starting to. And so my goals for this year have been delayed, just like the Fed pivot has been delayed. But that's definitely coming next year. And so I expect 2023 to be a lot like 2019, which in turn was a lot like 2010. And those years were years where the Fed was pivoting and getting ready to restart QE and cut rates. But it took a little while for that to sink in to the markets. And the first half of 2010, the first half of 2019 were kind of choppy and sideways. But once the markets figured out, oh, wait, here comes the printer being turned back on, gold and silver rallied like crazy 2010 to 2011. And they rallied like crazy in the summer of 2019, then took a break, and then with COVID soared again. So I expect 2023 is going to be a lot like that, because where, again, just like in 2019, all these 8-figure Wall Street economists were talking about no rate hikes and the 10-year note going to 5% in 19. They were dead wrong. They're dead wrong now when they're saying no rate cuts, and the 10-year note yield continuing to go up. So as we figure that out, and as the world figures that out next year, precious metals prices will finally break out to the upside, above 2,000 in gold and above 28 in silver. How far they go? Okay, I don't know. We'll have to see. I'd say, at least 10% above the previous highs, which would put gold up to about 2,300 at some point late next year. Maybe silver up 35-ish, something like that. But if the supply demand things get all out of whack, and if, say, in silver and some of the other metals, there becomes real stress for physical supply and physical demand, well, then prices could be a little bit higher. But I definitely think, we're ending the year, gold's ending the year about unchanged on the year, which is way better than stocks and way better than bonds. And gold's going to outperform both of those next year, too.
Well, Craig, that's all we have for you today. Thank you so much for coming on with us today and all this year, really, and spending so much time updating us with your knowledge. It's been very much appreciated, and I hope you have a great Christmas and hope to see you in the new year.
Yeah, look forward to it, Cassandra. Merry Christmas to you and everybody on your end. And yeah, let's get ready for a crazy 23.
Thanks so much for watching today. We'll be back again tomorrow with the latest from Gareth Soloway. So be sure to stay tuned by hitting that notification bell and subscribing below. Bye.